What's going on, everyone? In chapter 2, we're going to focus on accounting for what's known as accruals and deferrals. So, you ready? Let's go. So, does my slideshow change? Let's go. There we go. So, what is an accrual? It refers to a revenue or expense event that is recognized before cash is exchanged. To simplify that, it means that although we're going to recognize the revenue, it means that cash has not been received. See, you recognize revenue when it is earned, not based upon when cash is received. So if I provide a service today and you don't pay me until a month from now, under accrual accounting, I can still record that revenue as of today. When it comes to expenses, you recognize your expenses when they occur, regardless of whether or not cash has actually been paid out. So if an expense takes place today, although you haven't paid for it yet, you still record the expense. That's known as an accrual accounting system. Under an accrual accounting system, you recognize revenue when the revenue has been earned and record your expenses when they are incurred, regardless of whether or not cash has been received and or paid out. Now, with deferrals, a deferral is a delay in the recognition of a revenue or expense after cash has been exchanged. So a deferral is a revenue expense event that is recognized after cash has been exchanged, meaning that cash has been received and or paid. However, the revenue or expense has not yet been recognized. So we have an entire chapter focused on how to account for accrual transactions and deferrals. We're going to go through a series of transactions for a company. We have Cato Consultants started on the 1st of January when it acquired 5,000 cash by issuing common stock. We're going to use the accounting equation to record this transaction. Remember that assets equal liabilities plus stockholders' equity. So your cash account would increase by 5,000. That's an asset. Common stock also increased by 5,000, which falls up under stockholders' equity. This transaction will not impact the income statement because it does not involve a revenue account nor an expense account. On the statement of cash flow, you will have an increase of 5,000 from a financing activity. So you see how this transaction also impacts your financial statements. For our next transaction, we provided 84,000 of consulting service to the client. Here's the key, but has not yet collected any cash. So we've done the actual work, but the client has not paid us. So the question is this a revenue transaction? The answer is absolutely. Under accrual accounting, you record revenue when it is earned. It is not based upon the amount of cash being collected. So notice on the account equation under assets, we have a new account title called accounts receivable. This account here, where's my little cursor? It's known as accounts receivable. This account shows money that is owed to the business from providing services or from the sale of products. In this situation, account receivable is an asset. It is something of value that is owned or controlled by the business. So your assets increased by 84,000 and retained earnings increased by 84,000 because your revenue increased by 84,000. So the account equation is still in balance. If doing an income statement, we're showing 84,000 in revenue, no expenses, that income was 84,000. Because cash was not involved, it did not impact your statement of cash flow account. Now for our next event, we collected 60,000 cash from the customer in partial settlement of account receivable. So the client owed us 84,000. They just paid us $60,000. So we're saying, well, how does that transaction impact the account equation? Well, cash would increase by 60,000. Account receivable would decrease by 60,000. So now we have two asset accounts involved in this transaction. That's an asset exchange transaction, whereas one asset increased and the other account decreased by the same amount. This transaction doesn't impact liabilities nor stockholders' equity. It doesn't impact the income statement, but the statement of cash flow, there will be an increase in cash of 60,000 from operating activity. So again, we're showing how each of these transactions also impact our financial statement. Want some more? Got some more for you. Next, we paid the instructor $10,000 for teaching training courses. Again, they paid the instructor $10,000 for teaching training courses. That's known as an expense. And to be more specific, it's going to be a salary expense. So because you're making a payment, the cash account decreased by 10,000. Retained earnings also decreased by 10,000 because expenses decrease your retained earnings. On the income statement, we're showing expense for 10,000, which for this transaction only will result in a net loss. Parentheses mean that number is negative. And under our statement of cash flow, we have an outflow of cash of 10,000 under your operating activity. So again, we're seeing how each of these transactions are impacting our financial statement. Got some more for you. Next, we paid 2,000 cash for advertising costs. All right. So now your cash account decreased by 2,000. Your expenses increased by 2,000. But once again, expenses decrease your retained earnings. You see 2,000 expense impact your income statement. On the statement of cash flow, we see that our operating activities will show an outflow of 2,000 for the cash account. Want some more? Next, we signed a contract for 42,000 of consulting services to be performed in year 2. Now, notice we're still in year 1. All we did was sign a contract. So as of right now, this is not a business transaction. Therefore, it does not impact our year 1 financial statements. Okay? Want some more? At the end of year 1, they recorded accrued salaries expense of 6,000. The salary expenses for the courses that instructor taught in year 1 that Cater will pay cash for in year 2. Now, keyword, accrued salary expense. It means that this expense has already taken place. However, it has not yet been paid. So under the balance sheet, your liabilities will increase by $6,000 because this money is owed to the instructor. Under your stockholders' equity, retained earnings will decrease by $6,000 because, again, expenses decrease your retained earnings. Under the income statement, 6,000 expenses for this transaction alone, it would give you a net loss of 6,000. There's no cash involved, so it does not impact your statement of cash flow. So this is an accrued transaction where the expense is being recognized before cash is actually being paid. Okay? So here it is, accrued expenses or expenses that are recognized before cash has been paid. Adjusting entries or update the accounting records and do not affect cash. So with this adjusting entry, what they're referring to, this would be a transaction made at the end of the accounting period in order to update our accounting record. Because the expense took place in year one, it has to be recognized on the year one financial statement. Salaries payable is a liability representing the amount owed to our instructors because it represents a future cash obligation. It is shown as a liability. All right. So now we have a summary of all of those transactions 1 through 7. So now what the cash account shows is your ending cash balance. This shows the amount that is still owed to us from our client. They owe us $84,000. They paid us $60,000, so they still owe us $24,000. We owe $6,000 to our employee or our instructor. Common stock is $5,000, and retained earnings has an ending balance of $66,000. Now, once again, the account equation has to be balanced. So when you add your assets, they total $77,000. The liabilities plus stockholders' equity, you add these together, they must also total $77,000. Okay. Now, what we've been doing all along is showing the impact each transaction has on our financial statements. We're now going to put those all together. So overall, total revenue was $84,000. We had $16,000 in salary expense, $2,000 in advertising expense, which yielded a net income of $66,000. So the income statement shows your revenue accounts and your expenses. You subtract total expenses from revenue to get your net income or your net loss. If this number is positive, it means you've earned net income, but if it was negative, you would record it as a net loss. On our equity statement, this is our first year of operation. Beginning common stock was 0, but we issued 5,000 common stock. The 66,000 of net income is coming from your income statement. Therefore, our total stockholder equity at the end of the year is equivalent to $71,000. Now, on the balance sheet, it's a summary of all of our assets, liabilities, and stockholders' equity. So we have the two asset accounts, cash and account receivable. They total $77,000. Salaries payable is a liability for $6,000. Equity has two components, common stock and retained earning, and they total $71,000. And yes, the balance sheet has to balance. Your assets must equal your liabilities plus stockholders' equity. Okay? On the statement of cash flow, this is showing our cash inflows and outflows based upon types of activities. Under operating activity, we had an inflow, cash from customers, outflow for salary expense and advertising expense. So overall operating activities, we had a net cash flow, which means an increase of $48,000. We did not have any investment activities. We didn't acquire any long-term assets. Under our financing activities, we did issue common stock for $5,000. Therefore, our overall net change in cash was $53,000. Beginning cash was 0. Ending cash balance was $53,000. Now I know that was a lot to digress. Take that in. So carefully study the chapter 2 part 1 video lecture. I'm going to come back with more on how to account for accruals and deferrals. Stay tuned.